The words emergency meeting carry a special, heavy weight when they come from the Federal Reserve. This is not an institution built to move quickly or react emotionally. The Fed is designed to be slow, deliberate, and painstakingly careful, which is exactly why markets globally pay attention when it suddenly isn't. An emergency meeting implies one thing: something has broken, or it is very, very close to breaking. And right now, all eyes are fixed on one market that many people ignored for years: silver. For decades, silver was treated like gold's quieter, less exciting cousin. It was useful, sure, valuable for jewelry, essential in electronics, and now foundational for solar panels, but it was rarely viewed as a system-shaking, crisis-level asset. The perception has changed dramatically, and now the potential for a catastrophic move in silver is driving real fear in financial centers. When silver breaks through key psychological levels, it tends to do so violently, leaving everyone behind. And a sustained move to $200 is not just another price spike. It is a clear, screaming signal that stress inside the financial system has reached a level that policymakers can no longer politically afford to ignore. But why silver? Why would the price of this specific metal force the hand of the most powerful central bank in the world? To understand why the Fed would be under such intense pressure, you have to grasp what silver truly represents in today's complex, debt-laden global economy. Silver is absolutely unique because it is both a critical industrial metal and a powerful monetary metal. On the industrial side, its demand is exploding. It's in your smartphone, in electric vehicles, in crucial medical equipment, and most importantly right now, it is integral to the entire green energy revolution, especially solar energy. This means silver is inherently linked to global economic activity and the future of energy policy. But then there's its other side. Silver has thousands of years of recorded history as reliable, portable money. That dual role makes silver uniquely sensitive to inflation, to aggressive currency debasement by central banks, and to massive supply shortages, which are currently worsening. When massive numbers of investors rush into silver, they are doing more than just betting on industrial demand. They are explicitly expressing a profound fear about the future purchasing power of paper money, or fiat currency. A move to $200 for silver suggests that fear is no longer confined to a small, isolated group of precious metals enthusiasts. It has gone entirely mainstream. It means the public is waking up to the reality that the currency they hold is being eroded away at an accelerating pace. When gold, the traditional safe haven, makes a move, it's about macro fear. But when silver explodes, it suggests something deeper, a systemic failure in confidence. It indicates that the industrial economy, the monetary system, and the policy responses of governments are all fundamentally misaligned and heading toward a breaking point. This is the scenario that drives the need for an emergency meeting. The Fed's primary goal, above all else, is maintaining faith in the dollar and preventing widespread financial panic. A $200 silver price is the physical manifestation of that faith dissolving. If the Fed calls an emergency meeting right now, it isn't to tweak interest rates by a quarter point. It is to address a perceived existential threat to the stability of the financial system. And the market signal they are terrified of is silver finally recognizing its true monetary value after decades of suppression. Thank you for watching, and follow for more detailed market analysis. Now place yourself inside the Federal Reserve at this moment. Inflation has already proven more stubborn than expected. Interest rates have risen faster than at any time in decades, yet debt levels across governments, corporations, and households are higher than ever. Raising rates further risks breaking something important, while cutting rates too soon risks reigniting inflation. This is the classic central bank trap, and silver screaming higher is like a warning siren blaring in the background. Historically, explosive moves in precious metals have coincided with moments when confidence in central banks starts to crack. In the late 1970s, silver surged as inflation ran out of control, forcing the Fed under Paul Volcker to hike rates aggressively, triggering a recession but restoring credibility. Today's situation is different because the system is far more leveraged and far more interconnected. The 48-hour clock matters because markets move faster than policy. If silver is breaking $200, it implies stress in derivatives markets, particularly in futures and options tied to silver pricing. Large banks and financial institutions often hold complex positions that assume relatively stable prices. A sudden vertical move can trigger margin calls, forced liquidations, and cascading losses. This is where the words emergency meeting stop being dramatic and start being practical. The Fed is not just worried about the price of silver, it is worried about who might fail if the move continues unchecked. Think of it like a dam developing cracks. The water itself is not the enemy, it is the pressure building behind it. Another layer to this crisis is the physical silver market. Unlike digital assets or even many stocks, physical silver has real-world supply constraints. Mining production has struggled to keep up with demand, and much of the easily accessible silver has already been extracted. At the same time, industrial demand continues to grow, especially from renewable energy and electronics. When investors rush to take physical delivery instead of settling contracts in cash, the system feels it immediately. Vault inventories shrink, premiums rise, and confidence in paper claims weakens. A $200 silver price suggests that paper promises are being questioned, and that is a nightmare scenario for a financial system built on leverage and trust. For Jerome Powell, the challenge is brutal. Do you step in aggressively, risking accusations of market manipulation, or do you wait and hope the storm passes, risking a full-blown confidence crisis? Every tool the Fed uses has side effects. Liquidity injections can calm markets, but they also signal weakness and can push inflation higher. Rate cuts might relieve pressure on banks, but they also confirm that the Fed is prioritizing stability over price control. Doing nothing, however, may be the most dangerous option of all if markets interpret silence as paralysis. This is why emergency meetings are often as much about communication as they are about policy. Sometimes a carefully chosen sentence can move markets more than an actual rate change. For everyday viewers, the big question is, what does silver at $200 actually mean for you? It means the cost of raw materials is rising, which eventually feeds into consumer prices. It means trust in fiat currency is under strain. It means that hedges against inflation and systemic risk are suddenly working exactly as designed. Even if you do not own silver, you are affected by what it represents. When a thermometer shows a fever, the thermometer is not the disease, it is the signal. Silver is acting like that thermometer right now, telling us the financial body is overheating. Historically, when central banks lose control of the narrative around money, people turn to assets they can touch and measure. Gold, silver, and other hard assets regain relevance. This does not mean the system collapses tomorrow, but it does mean the margin for error has shrunk dramatically. Powell's 48-hour window is not about fixing everything. It is about preventing panic from becoming self-fulfilling. Markets are psychological machines as much as mathematical ones. If participants believe the Fed has lost control, they act in ways that make that belief real. As silver continues to surge, attention will shift rapidly from price charts to balance sheets, from headlines to plumbing, from what things are worth to whether obligations can actually be met. This is the moment when hidden risks tend to surface, because stress exposes weaknesses that calm conditions hide. The emergency meeting is not just about silver, it is about confidence, credibility, and control in a system that depends on all three. And the next move the Fed makes will echo far beyond this single metal, because